Hi, it's Nero here from Investment Rise, and today I want to talk about what's actually happening in our Australian property market. Because right now, it seems that almost everyone is talking about a property boom. We've got Westpac, who are expecting 15% capital growth across the country, with Brisbane expected to lead the way with a spectacular 20% of capital growth over the coming 3 years. We've got ANZ, who are expecting 9.5% capital growth. We've got CBA, who are sitting at around about the 10% mark. And we haven't yet heard from NAB, although I expect they'll be somewhere similar as well. Then we have CoreLogic, who've come out and said now that we've seen October price data, we've seen November price data, and for both those months, property prices across the country have actually increased. So it seems that right now, property prices certainly are on the move. And then according to the Australian Bureau of Statistics, it seems that right now, Australians, we're in a bit of a buying frenzy. In fact, the amount of money borrowed to buy housing just hit a record $22.5 billion in October. And what's being interesting when you look at the graph is that the majority of this activity is owner-occupied activity. So it's people either upgrading their homes, buying their first homes, or refinancing their own home for a better rate to unleash equity, whatever the case might be. But investment activity is still low. And in fact, when I speak to a lot of investors, the common theme seems to be, well, how can we be talking about a property boom when there are all these units sitting there on the market that are currently vacant? Many investors are having to drop their rent because it's hard to get a tenant on these units. And so it's no wonder then when you kind of hear this two sides of the story. Someone saying that there's a boom, but then others saying, oh, hold on, our units aren't renting, the unit market is in trouble. It's no wonder many investors are kind of sitting on their hands, waiting to see what's going to happen, waiting for the perfect time to buy. It just doesn't seem like these two stories add up. Or do they? What happens if instead of looking at the Australian property market as a whole, we split it? We look at the unit market and we look at the freestanding house market. We actually look at those two markets differently. Now, mind you, what I think is going to happen is that this post-COVID environment that we're in is only going to accentuate what's already been happening over the last few years. And what I mean by that is this. Over the last, I would say, 5 years, since about 2015, the freestanding home market and the unit markets have actually performed differently from both a capital growth perspective and from a rentability perspective. So in fact, let's go now and look at the rolling rents of houses versus apartments for the last 3 months. And when we look at the data, what we see is, as expected, rents across units have dropped, right? That should not come as a surprise for you. But when you look at the average rents across freestanding homes, rents are actually on the increase. So many property investors who have gone down the path of buying freestanding homes rather than units are actually seeing their rents on the rise. They're seeing their returns increase, right? And that's the first change that we're seeing between units versus houses. But then consider this. If you look at Australia as a whole, where are the majority of units located? Sydney and Melbourne, right? And so what's happening though in those two markets? Well, Sydney and Melbourne right now are the two markets that are a bit of a drag on our Australian property prices, right? So even though, yes, average property prices across the country are rising, when you break it down, it certainly looks like Sydney and Melbourne are the two markets that are struggling the most. Yes, there are certain pockets that are rising, but overall, those two markets are not performing as well as many other markets around the country. So it's no wonder then that many investors from Sydney and Melbourne are going, what property boom, right? Okay, and they're sitting on their hands because we're so used to seeing the typical pattern of Sydney leading the property boom, Melbourne then to follow, and then the rest of the country kind of playing catch up. Well, that's not going to be the case this time. The boom is going to work very, very differently. And also, we're going to see, as I said earlier on, houses perform very differently to apartments. So if you think you could do what maybe some people did 5 to 10 years ago, and that was buy an off the plan unit somewhere and have it be worth $200,000 more than what you paid for it by the time it completes and settles, I think you're going to be in for quite a rude and painful shock. I think those days are well and truly behind us, at least for the next few years. Because the old investing paradigm was, if you can't afford a house in a particular suburb, then go and buy a unit, right? Because then you'll be fine, because as long as you buy in the right location, you're going to be okay. But the fact is that paradigm has changed. So let's take Melbourne for example. Over the last 5 years in suburbs like Abbotsford, Doncaster, Richmond, unit prices in 2020 are about what they were all the way back in 2015. Okay, take Sydney, right? Let's take two suburbs like Strathfield and Castle Hill. Now, in those two suburbs, the freestanding house market has risen considerably. House prices in 2020 are much higher than they were back in 2015. But the unit market, the average unit price in Castle Hill in 2020 is about 1% less than it was in 2015. And in Strathfield, average unit prices are about the same in 2020 as they were back in 2015. So what does that show you? That shows you that you can't apply the old paradigm of, I want to buy in this particular suburb because I think it's a great suburb from a perspective of capital growth. All right, I can't afford a house, I'm going to buy a unit there. It's not going to work that way. All right, so if you haven't already got a key takeaway message, I'm really hoping you get this, and it's that focus on freestanding homes for your next investment property. If you can't afford a home in a particular suburb, don't buy an apartment there. Go elsewhere. Look for another suburb or another area where you can find a freestanding home that meets your particular budget. And if you live in Sydney and Melbourne, be open to investing outside your local markets, right? Because Sydney and Melbourne, I believe, will be the two markets that are probably going to struggle a little bit for the next few years. Why? Because they're the two markets that are most vulnerable to overseas migration. They're the two markets that have most exposure to overseas students. Two things that are in very, very short supply. And it's no wonder prices in general are still struggling in many pockets of Sydney and Melbourne, right? But then you take a city like Brisbane, where 60% of the suburbs have recorded price growth in 2020. And there are also many regional areas that are really leading the growth in terms of prices. Some of them have even risen as much as a third in just 2020. So you really want to do your research and look at areas where you're going to get maximum capital growth. But the question though is, for many people, well, what's driving this price growth? I mean, it's not as if our population is rapidly expanding because we don't have migration. So what is it that's driving it? Ultimately, comes down to one thing: money. Let me explain. First of all, we have record low interest rates at the moment, right? And property prices have always been fueled by low interest rates. And so when you consider interest rates at record lows, when you consider fixed interest rates, many of them are about half of what they were pre-COVID, it is easier than ever to borrow money. It's easier than ever to afford property, and right now, even with prices rising. Then we also have to consider that lending restrictions are gradually being unwound, making it easier for people to borrow, so you can borrow more now, and certainly from March next year, you'll be able to borrow more than you could previously without you earning any extra money. Okay, so access to credit has never been easier and never been cheaper. Then number two, and this is going to sound totally crazy, and I couldn't believe it until I saw the data myself. But let's have a look at the CBA Cash Savings Indicator. And what that shows us is that, first of all, it's based on the average total savings per household, including home lending related savings and transactions or saving statements. And it's rocketed up to be 15% higher than it was this time last year. And CBA believe it's still growing. So that means that CBA believe, according to their data, the average household has 15% more cash than they did in savings this time last year. And with record low interest rates, people know that no matter how much cash they have, they're not going to be able to save their way to financial freedom. So sure, a lot of that money is going to find its way into the economy in terms of consumer goods. So yes, I expect more people are going to buy, big screen TVs. But at the same time, a lot of this money is also going to find its way into property because more people have bigger savings. They've got more deposit power, so they've got the ability to save the deposit, or they've saved that deposit already, which means with the easier access to borrowing, they now have the deposit. They're going to be able to build that property portfolio as well. And that's going to fuel property prices even more. In fact, according to CBA's calculations, there's $100 billion worth of extra savings that's been accumulated since the start of COVID-19. $100 billion, right? That's huge. And then when you consider not just low interest rates, not just easy access to credit, not just the fact there's now $100 billion worth of savings that Australians didn't have before, but the fourth thing is that our Australian government has pumped in, on last count, around about $300 billion worth of fiscal support to support and prop up our economy. Now, a lot of that is also finding its way into property, construction, and everything else. So with all this money either lying around in savings accounts or with all this money, in the economy, and people have access to that credit to fuel it into property prices, it's no wonder property prices are rising. But there is no doubt about it that certain suburbs are going to perform differently. If you think that the markets that performed the best in the last property boom are going to be the same ones that perform the best in this property boom, I think you're going to make some wrong decisions. We're starting to see the data right now. Look at the regional areas that are doing very well. Even in Sydney and Brisbane, which markets are doing quite well at the moment, the best performing areas are the suburbs on the fringe, the outer suburbs, the freestanding house market. It's not the unit market. So yes, there is going to be a lot of money, I believe, to be made from property investors. Yes, it has never ever been easier to get both positive cash flow and capital growth, but certainly do your research, identify the right opportunities, and I believe you're going to have a great time with property investing from 2021.
Hey, thanks so much for watching. If you found this video valuable and you're thinking you might like my help to help you find an investment property, then head on over to nerocall.com to discover our unique 5-step process that's helped my private client group purchase now well over $66.2 million worth of property. And then if you like what you see, you can book in for a half-hour phone consult with me personally. Either way, thanks again for watching.